If you're a director and your business is under pressure right now, cash flow's tight, creditors are calling, and you don't know what your options are, then this video is a must watch for you. Because today I'm going to sit down with Emily, one of the Director First team, and we're going to break down some real life insolvency cases that we have been dealing with. We're going to walk you through exactly what their problems was, what we suggested, and how we helped. Now, this isn't theory, this is what's happening right now to directors in the UK, and if they don't act early and take the right advice, the consequences are pretty serious. So if you're stressed, you're stuck, or you're just unsure what your options are, stay with us, because this story could be the difference between saving your business or losing it. Emily, welcome back to another episode of our Director First podcast.
Thank you for having me.
It's okay, you only sat over there. You've not come that far today, have you?
No.
Listen, let's get into it, right? Let's talk about a recent case. Obviously, keep it confidential. We don't want to, say directors' names or business names, but let's talk about one. Tell me what was going on, and we'll sort of walk through what those solutions were.
Okay, so a case recently, it was a hair and beauty salon.
Okay.
He had, HMRC was owed about 30,000. He had a bounce back loan, about 12,000 remaining.
Okay.
And that was it. There was no overdrawn director's loan. He had assets in his balance sheet. They're worth about 15,000. Basically, he was getting pressure from HMRC, so he wanted to know what his options were. Okay,
let's sort of dig into this a little bit then. Right, so how much were HMRC owed?
30,000.
30,000, and I think this one is where HMRC had actually, they come to the premises and they were talking about a Control of Goods Act?
Yes.
Okay, so for people that don't understand, what HMRC are doing at the moment, if you are behind and you are failing on time to pays, or you are not communicating with HMRC, they come to the premises with a clipboard and pen, and they go round your premises and note all your assets down. And once you've signed that Control of Goods, HMRC own it. And if you don't pay it within a fairly short time spell, they're going to come and actually take stuff from your business. And a hair salon with no tables, chairs and stock's going to struggle to cut any hairs. Okay, were his returns up to date?
Yes, they were.
Okay, excellent. Now, bounce back loans, obviously the majority of cases we deal with bounce back loans have got them. I am presuming you went into, did he take the right amount? What was the bounce back loan spent on?
It was just spent on things within the business.
Okay,
so
excellent.
Staff payments, stock, stuff like that to help them get through COVID.
Okay, cool. Now, how many staff were there?
12.
And what was the intention with the staff? What was his outcome he was looking for?
To keep them on.
Okay,
yeah.
Okay, cool. What was his biggest worries?
It was HMRC, because they were putting the most pressure on him. Obviously, they have their return clients. It's a business, they can't really just stop for a few days or a few weeks, because their customers come in every day. What
had caused the problems? Why had they got to this position with HMRC and the bank?
They just, I guess, buried their head in the sand. I mean, they were up to date with the bounce back loan option. Bounce back loan payments. They'd exhausted all their options, and they just kept trading as per normal, just sort of ignoring HMRC, just thought they'll just get to that later. But then obviously HMRC came knocking, wanting for payment.
And I think that's the problem with businesses with HMRC is, HMRC, if you ignore them, okay, you probably won't hear anything off them other than letters and phone calls for a couple of months. And I've done it before in a previous business. Like we were behind with VAT, and I thought, you know what, we'll make it up next quarter. And because the pressure wasn't, like creditors generally, those who scream loudest will get paid first. That's not the way that you should do it, but that's the reality. And because you're not hearing off HMRC, it's like, I'll deal with the VAT bill next quarter. And you almost forget about it, and then the next quarter comes and you're like, things haven't quite gone as you wanted, and you're like, whoops, now I can't pay the next back quarter. And from not hearing from HMRC at all, then they're on the doorstep. And there's nothing worse than an enforcement agent being there, you know, especially if you're a hair salon, because your customers are seeing it, your staff are seeing it. Okay, so what were the main questions that this director had for us?
Basically, if he could continue trading without any disruptions, what his options were, if he could liquidate and start again. For him, the lease was actually in his personal name, so it wasn't in the limited company name. Their rent was up to date and everything like that. He wanted to keep the assets, he wanted to keep all of his stock. He just basically didn't want there to be a disruption to his business while, you know, sorting everything out.
Okay, well, let's look at the options that we gave this director. So the first one, let's talk about non-insolvency options, because that's really where we always start. You know, if we can help someone avoid insolvency, that's the main game. Non-insolvency options would be to organise a time to pay arrangement with HMRC, and that's where you pay those arrears over a period of time. You know, it can be 12 months, 24 months, 36 months in some scenarios. But the key thing is be organised when you make that call to HMRC. Don't just go, I need 2 years with nothing to back it up. I always advise directors to have some cash flows and explain why, if they support us, we'll keep this business going and become successful again or profitable again. Problem with time to pay sometimes is if you failed previous time to pay arrangements, and I think this was the issue with this one, they'd failed previous time to pay arrangements, so the HMRC are now getting at the end, they're just very sceptical, aren't they? You know, they'll give you one time to pay, but if your returns aren't up to date or you fail on the payment plan that you've agreed, it essentially gets ripped up and they're back on your doorstep. And I think that was the case with this one.
Yeah, and HMRC just weren't willing to give him enough time to pay. I think they offered about 6 months and it just wasn't affordable to them to spread it out over that period of time.
So that sort of forced the guy down to into an insolvency route. And I mean, one of the things you can discuss is like a CVA, and that's where it's a more formal process where an insolvency practitioner oversees a CVA and you pay your debts back over a period of 5 years. But the debt levels we're talking about, it's not really suitable. There'd be a lot in fees comparative to what he actually owes. So I think the option we're looking at is liquidation. Now, the business is insolvent because it can't pay its debts when they fall due. Its liabilities are more than its assets, and it's about to get some legal action from HMRC. So this business in an insolvency, in a creditor's voluntary liquidation, those debts would be written off. The bounce back loan would be written off. The bank would be paid from the guarantee. We've checked whether or not the director took it in the right manner, spent it in the right manner. Obviously, for those watching, if you've took too much on a bounce back loan or you've spent it incorrectly, that is going to cause you an issue in insolvency. We've looked at, can we restructure the HMRC informally? The answer is no. They're sort of pushing this director into an insolvency process. So the process of liquidation, because there's a business in amongst this, and the ideal outcome is the director starts again. Now, they can do that as long as they follow some strict processes. Now, I believe you introduced the business to an agent and the agent valued the business, the tables, the chairs, the mirrors, the hairdressers, the stock, okay? The reason why that's so important is when you put a business through an insolvency process, the insolvency practitioner is going to look as to what's happened and they want to see whether or not you've taken assets out of an insolvent company and moved them to a new company. It's called a transaction under value, okay? And if it's seen that you've moved assets out of your business for the incorrect consideration, there's an action that can come from the insolvency practitioner to your new company. So did you guide them through that process?
Yeah, so basically he was the sole director of the company. So the assets in his balance sheet, they were valued at about £12,000, I think.
Okay.
He sent through all the pictures to the valuer, but a lot of it was worn and torn, and it just definitely wasn't worth that amount.
Okay.
So the value of the assets came back at £5,000 plus VAT.
Okay.
So the director was very pleased with that because he thought it was worth, a lot more based on the balance sheet.
And we can dig into that now, right?
Yeah.
So to check whether what you think your assets is worth, you can pull up your a balance sheet on your accounting software or your last set of accounts, and it will be in their fixed assets. The reality, though, in insolvency, when you get an insolvency valuation done, the agent's generally going to give two figures, and I know the in situ figures, what you're talking about, is what he believes this business is worth to him, and that will be what the fixed assets were. There will have been, I think it was £1,000 or so for the goodwill of the business. So he believes the business was worth £5,000 to the current director. Now, the ex situ is what he believes these assets will fetch at auction. And I know it was very low on this one because the stock is perishable.
Yep.
Therefore, if it's kept for too long, it's got no value. And second-hand tables and chairs and mirrors, they're not worth a great deal at all. So this director made an offer close to the in situ value to the agent, and the agent said, "I'm happy to sign that off. This is a reasonable offer for that business."
Correct.
Now, people watching might go, "Well, he's got loads of clients. Surely there's a value to that." And the reality is we're hairdressers and and I've dealt with therapists, physios. They're not contracted clients. They could leave and go to another hair salon at any stage. And even though it's a limited company, the clients are generally the stylist's clients, and they'll follow the stylist round.
Yeah.
So what this director was able to do, if I can remember rightly, the charge for insolvency was £5,000 plus VAT. Did it have any cash in the bank, this business?
Minimal, 1,000, yeah.
So he needed to find the £6,000 to pay the liquidation fees.
Correct.
And what he did by the way that this played out is his new company paid the £5,000 into the business account as per the agent's valuation, and there was enough money in that in the business account now to actually pay the insolvency practitioner's fees. So what did it cost in total for them?
5,000 plus VAT.
Okay.
So he was of the understanding he would have to find the 5,000 plus VAT to pay for liquidation fees, and then another 5,000 plus VAT to pay for his assets.
Okay.
But it worked out that you only had to pay the 5,000 plus VAT because the new company bought the assets.
Yeah.
And then he used the money for that asset sale to pay for the liquidation.
And we've run all this through the appointed liquidator before the directors made any decisions. Okay, cool. So it's really a dream outcome for the director. He's been able to start again. The fact that he has a lease in his personal name, that's helpful, isn't it? Because there's no assignment needed. Yep. And have all the staff been paid over to the new company? Okay.
And no disruption to the business whatsoever.
Excellent. So he will have stopped trading in old company on a Friday. On the Saturday, he set up with his new company with a bank account, merchant terminal, insurance is in place, the staff have been moved over. Okay. Now, what we need to point out for people is, people are going, well, he's done that and he's shed 40, 50 grand worth of debt. Well, he's dodgy. Listen, the options that he had is he was going to be forced down the route of insolvency with HMRC. The next thing they'd have done is done a winding up petition, or they'd have took his goods. If they'd have took his goods, his business would have been over. The staff would have lost their jobs. There'd be no more tax revenue coming from that company. If they'd have wound him up, that's where you get a winding up petition. The official receiver then investigates your conduct, and the first thing that they're going to say to you is, well, you've not behaved properly, because a director, when you're insolvent, the first thing you're meant to do is not make the creditor's positions any worse. And again, the official receiver would have closed the company down. he's actually done the right thing here by everybody. He's had a valuation done independently, saying that this business doesn't really have a great deal of worth to anyone else. Okay, we talked about director's loans. We've got to talk about those in every video. How did we check whether or not he had a director's loan account that was overdrawn?
Sure, he sent through an up-to-date balance sheet and the company actually owed him money.
Excellent. So, and that's why it's important for directors out there, having something like QuickBooks, Free Agent, Sage, Xero, and having a bookkeeper update it is really, really important, because when you go to insolvency, at the point you stop trading, we need to understand whether you owe the company money or the company owes you money. Now, if the company owes you money, sadly, that's not great news, because you're not going to get it. You are another, and that's another thing. This guy sort of stood shoulder to shoulder with HMRC. He was a major creditor, wasn't he? But if you owe the company money, tell us why that's a problem.
If you owe the company money, then in liquidation, it becomes an issue, because the insolvency practitioner wants some of that money back.
They're duty bound to recover that money and ask you to pay it all back, aren't they?
Yeah, exactly. And again, it just depends on the director's personal circumstance each time, but it's just something that we address before,
That's it. Why are we different? Why? And we're not here to slag anyone else off, right? But what do we do different at Director First?
We safeguard directors. We look at their situation as a whole. We look into everything before we even, send out a proposal. And we let them know, look, if you go into liquidation, this is what it's going to look like. We'll address if there's an overdrawn director's loan. We'll make sure that if there's a deal to be done, we can get that deal done. We'll put everything in writing, and that we look after the director. Yeah,
within reason. I mean, we don't sweep anything under the carpet. We don't break any rules. But our job is to help them understand everything up front. We don't charge them a penny to do this. We put all the effort in. If there is a director's loan, I mean, here's the key thing: is we help them understand what the director's loan account stands at.
Yeah.
Because, I mean, we're going to come on to another video, so I'll perhaps leave that for another video. But the key thing that we do here is we're there to help them understand everything.
Yeah.
It's not generally just the $5,000. And in this case, it was a $5,000 liquidation, but that's not very common, is there? There's normally something else. So, listen, anything else you want to talk about on this particular episode?
No, he's just left me a lovely review today, so it's another happy client of ours.
Brilliant.
And he's also referred more people to us, so that's, speaks volumes for itself.
Shows we're doing a good job, doesn't it? Brilliant. Thanks for joining us.
Thanks.